Good day, you're watching Businessworld Live. I'm Delos Santos and here are today's top stories. The country's balance of payment deficit swells to a 4-year high in September. The Bangko Sentral is ready to utilize other tools to curb the peso's volatility, while Socio-Economic Planning Secretary Arsenio Balisacan says the government must do something about the sharp fluctuations in the forex market. The Finance Department believes POGO operations in the country may have contributed to the decrease in tourist arrivals from China. And travelers can expect lower airfares by next month as domestic airlines are set to cut their fuel surcharges. Let's begin our broadcast with the country's balance of payments deficit swelling to a 4-year high in September. Data from the Bangko Sentral show that BOP, which summarizes the country's economic transactions with the rest of the world in a given period, stood at a deficit of $2.3 billion last month. This was wider than the $572 million deficit in August and the $412 million gap in September 2021. This was the 6th straight month that the country's BOP position was in the red. The September 2022 figure was also the widest gap since September 2018. The Bangko Sentral said the deficit in last month's BOP reflected the outflows arising mainly from the BSP's forex operations as well as the national government's payments of foreign debts. Now, this one from the Philippine Star. The government is sticking with its growth target for 2023 even as elevated inflation is seen to weigh on the economy next year. The government has set an economic target of 6.5 to 8% for 2023. Earlier this week, Socio-Economic Planning Secretary Arsenio Balisacan said this could be slashed by 0.6 percentage point due to sustained increases in inflation. However, Balisacan says the government is keeping this target for now until they see the full picture of the economic situation through fresh GDP figures that will be released over the next 3 months. Balisacan notes that there are still many sectors that could drive growth as the economy is still in the final stages of opening up. These include the tourism sector, which is expected to grow further amid the easing of travel restrictions. Now, as government stands by its growth target, Senate Chief Arsenio Balisacan admits something must be done to address the fluctuating peso. Balisacan says the country must keep an eye out and do something about sharp changes in the foreign exchange market. This as the peso has become the worst performing currency in Southeast Asia as it dropped 13% against the greenback so far this year. However, Balisacan says he does not believe a weak peso will hurt the Philippine economy. Despite this, the Bangko Sentral stands ready to use other tools to curb the peso's volatility and says it has liquidity management tools as well as access to international financial agreements to provide insurance. The central bank has also pre-deployed non-monetary measures in a bid to control the peso's movement. Has government done enough, particularly the BSP, to smoothen volatility in the foreign exchange market, or do we have to step things up like our neighbors? To get insights, we have on the show Nicholas Mapa, senior economist over at ING Bank in Manila. Nicky, good day. Thank you for joining us. Again, you have Marcos saying that government is ready to defend the peso, but the BSP, on the other hand, saying that they're there basically to smoothen.
Yeah, I think it's pretty much the same thing. They're just trying to anchor expectations on the currency. The BSP has been, at any given day is present in the FX spot market to weed out any volatility or to smooth out any volatility, as well as to weed out, to look for any speculative actions out there. So I think the message is if you have legitimate requirements, if you're running a business or you need it for importation for your firms, then that's fine. Once you start to speculate, I think that's what they're trying to crack down on.
Speaking of which, again, you have the BSP stepping things up, like what you mentioned. They're warning against speculative trading. But apart from that, has the central bank done enough to intervene? Especially, of course, when you try to compare it to how our neighbors are moving, they have been more aggressive on that. And more on that point, what more can be done, and do they actually have enough in their arsenal, especially the reserves, to actually support the currency?
Yeah, so I think they touched on, they have been very active, proactive even. They raised interest rates aggressively to temper the depreciation pressure on the peso. They also have the reserves that they've been dipping into. As to your question, do they have enough? Well, they built up reserves throughout like the sort of throughout the pandemic. Most aggressive among central banks in building up its store of ammunition to deal with bouts just like this. So they built up their GIR to about 110 billion. Now they've dipped into it quite a bit, but they still have a lot more to go. We estimate that a lot of different measures of GIR adequacy are out there, but if we use a more accurate gauge of GIR adequacy, they have about 27 months to go before they actually run out of reserves. So it's quite a healthy and hefty stash they have of foreign currency to deal with bouts such as this.
On the other hand, you also have NEDA Secretary Arsenio Balisacan saying that the government must do something about the sharp fluctuations in the forex market, but at the same time he's saying that the weak peso won't hurt the economy. Do you still subscribe to that, especially at a time when trade deficit has widened to an all-time high?
Yeah, well, the BSP, that's more in the realm of BSP. They are trying to smooth out volatility. And if you look at trading for the past month, that's pretty much what's happened. Relatively more stable currency. There are, to be fair, there are depreciation pressures still out there. The sizable trade deficit continues to hound us and will likely hound us for the rest of the year with commodity prices at these levels. So for as long as the supply shock remains, we're probably going to see these types of trade deficits. In terms of it being, I guess, trying to find the silver lining, what can we do in a time of weaker peso? I think Arsenio Balisacan hit it right on the head. He's saying that you can't just wave a magic wand and weaker currency equals more exports. We have to address these more structural improvements to our export sector. We need to improve our infrastructure, our cost of power. All these little medium-term goals have to be addressed as well. So hopefully, with this new administration, they can address those issues, make us more competitive on the export side, so that we can find new sources of foreign currency. Right now, we have stable sources, robust sources like remittances, PPO, call center receipts. But we need to complement. We need all the help we can get. So hopefully, we can get the export sector off the ground. It's also a very good source of job generation as well.
But are remittances growing fast enough, Nicky?
Well, the thing with remittances, it's your sort of like steady burn, steady eddy. It's always there. It's only roughly about 2.5, 2.6 billion come sort of hell or high recession. It's even at the height of the pandemic, remittances continue to flow. But we need other alternative sources to sort of shore up remittances. Also, eventually as our export sector grows, it can deliver or provide more job opportunities for labor here. And maybe we give the OFWs a choice between staying here in the Philippines or going abroad. So if labor conditions improve here, if the job situation improves here, maybe we can give those OFWs that choice.
And then, of course, earlier we reported again balance of payments deficit at its widest in 4 years. What does this mean for the currency?
Well, as you noted earlier, the BOP is just the net of our dollars coming in and going. And right now we're running a deficit. So that tells us more dollars are leaving. You can trace that directly to the historic record high or record wide trade deficit. And once again, if you connect the dots, that's driven by your trade deficit, imports bloating because of the commodity prices. Also because we're reopening the economy, we're starting to bring in things that we weren't bringing in during the COVID-19. So that's, I think, going to persist. Once again, as long as the supply shock is there, as long as you have commodities at these levels, it's not just crude oil, it's coal, it's all these other hard metals, iron, chemicals, fertilizers. All these things are supercharged in terms of pricing. So that's going to weigh on our trade deficit. So I guess the battle cry right now is, we just bat down the hatches, try to weather this storm, but at the same time also look to medium-term solutions for this chronic trade deficit that we have.
Okay, and then of course, peso movement so far, we have yet to breach the 59 mark, but is it only a matter of time?
Well, I think there's so many factors in play. It's very difficult to give a level at this time. We still have the Fed. The
Mm-hmm.
question, where will the Fed take the Fed funds target rate? I think we'll base our expectations off them. Secondly, you have, of course, we know that the trade deficit will stay wide. We also know that we have, robust structural flows such as remittances, BPO
Mm-hmm.
call center receipts. So, all these inflows and outflows. We'll see how we'll see how things play out. But there are positives. We have the remittances, we have the BPO call center receipts. But once again, we have to deal with the record trade deficit that we're facing.
Okay, and like what you mentioned earlier, supply shocks showing no signs of slowing down. Inflation was at its highest last month. It's already showing a mixture of supply and demand pressure. Add to that, of course, second round effects. How are you forecasting price pressures for the rest of the year and all the way to 2023?
Yeah, unfortunately, the inflation picture does look like it will likely head higher. We talked about this on a previous,
Mm-hmm.
show of yours. We talked about the first half of the year being the first round effects.
Mm-hmm.
Now we're seeing a lot of the second round effects coming into fore. So the second round effects, which are sort of born out of first round effects, i.e., the supply shock that continues to pervade until now,
Mm-hmm.
the ongoing conflict in Russia and Ukraine is keeping commodity prices elevated. And as long as we have commodity prices at this level, you're going to start to see firms pushing up their prices, sort of pointing to expensive transportation costs, pointing to expensive utility costs. So everyone from restaurants, services, yes, some of it's demand side, but a lot of it's still cost push.
Mm-hmm.
But in this environment, when you see prices rising that way, you definitely need the BSP to step in and cool some of that demand side pressure. However, I would want to point out that if BSP is successful in bringing down inflation, it's only successful in bringing down demand side inflation. So,
Mm-hmm.
BSP can hike all it wants. It'll bring down inflation on the demand side, but as long as the supply shock is there, you're still going to see inflation driven by commodities.
And more on that point, the BSP is saying, at least Governor Medalla, they would like to maintain a 100-point differential with the Fed. Is that a wise move at this stage? And how do you see them moving in their next meeting?
Yeah, I actually have them increasing rates by 75 basis points just to keep in sort of maintain that differential. I think it's a decent differential to have to maintain FX stability, but at the same time, try also cognizant of the fact that you need to support growth at this stage of the game. You are right now running a debt to GDP ratio of 62.1%. Anything above 60 sort of leaves you susceptible to a ratings downgrade, and that's something that we want to avoid. Sure, it's nothing. Some people don't like chasing the debt, the credit ratings, but a credit rating at downgrade at this point will just add to the problems that we have.
It's still, like as we always say, it's still a delicate balancing act here. Thank you very much again for your insights, Nicky Mapa, Senior Economist over at ING Bank Manila.
Thanks. Stay safe.
Well, let's pause for a quick break, but coming right up after that. An industry leader in the real estate sector says now is not the right time to shut down POGOs in the country. More of that and other stories when Businessworld Live returns. Stay with us. And you're still watching Business World Live here on One News. I'm Jess Delos Santos. The Philippine Chamber of Commerce and Industry is set to submit its policy recommendations to the Marcos administration, and these include the provision of more assistance to small businesses. The Chamber will turn over a list of 10 resolutions to President Marcos today, October 20th, at the 48th Philippine Business Conference and Expo. The resolutions cover food security, health, employment, education, environment, power, and transportation, among others. PCCI says the national government should work together with the private sector to support new investments, generate employment, and provide assistance to pandemic-surviving micro, small, and medium enterprises. Aside from support for MSMEs, the Chamber is also urging Marcos to push for the ratification of the Regional Comprehensive Economic Partnership, or RCEP. PCCI believes this move will minimize barriers to the free flow of goods and services. Now, the decrease in tourist arrivals from China has more to do with COVID-19 rather than issues surrounding the POGO industry in the Philippines. That's according to Albay Representative Joey Salceda. During a House hearing on POGO operations, Salceda presented data showing a decline in outbound tourists from China, not only to the Philippines but as well as Cambodia. He says this is because China has not been letting people fly elsewhere due to COVID restrictions. Salceda made a statement on the back of concerns that the continued operations of POGOs could weaken the country's tourism sector.
Kitang-kita naman dito, wala naman diferensya kung may POGO ka o wala kang POGO eh. Talaga naman, wala naman talagang turistang pinapalabas ng China dahil sa zero COVID policy nila. At saka yung mismo Chinese ambassador nagsabi na walang relasyon yung dalawa.
The Department of Finance, however, says that POGO still left a dent on tourist arrivals from countries other than China. The department attributes the slowdown to the number of POGO-related crimes reported in the country.
It can have a direct effect also on the amount of tourists that comes to the country. Also, it can have an effect on foreign direct investment. In one study that we examined, that looked at the panel data of 67 countries. The potential losses with respect to FDI for the Philippines could range from 16.7 to 26.2 billion pesos.
Amid calls to shut down POGOs, Lee Chu Property Consultant CEO David Lee Chu believes this is not the right time to implement a total ban. In an interview with Businessworld Live, Lee Chu says the real estate sector stands to suffer if government decides to kick out POGOs altogether.
If we shut down the POGOs, then the velocity in the residential sector and the office sector will be hit quite negatively, and then that will impact sentiment, and everything else will slow down after that.
Now, consumers welcome the government's initiative to sell sugar at 70 pesos per kilo, but a business group warns that this move could be harmful to retailers. Gio Robles with a story.
Turon vendor Presi Estanislao reminds herself that patience is a virtue as she lines up to purchase cheaper sugar being sold at the Sugar Regulatory Administration or SRA office in Quezon City.
Mas mura po kasi dito kesa po sa supermarket tsaka sa mga palengke. Sa palengke po kasi 110, 105 na po.
The SRA offers these packs of white sugar dubbed as BBM sugar at 70 pesos per kilo. This is over 30 pesos cheaper compared to current prices in supermarkets. The SRA says the BBM sugar initiative, which kicked off Monday, aims to ease burden among consumers. A suggested retail price or SRP on sugar will also be in place later this month. Aside from the SRA compound in QC, BBM sugar is also available in Agriculture Department's Kadiwa centers in NCR and in SRA regional office in Bacolod City, Negros Occidental. Each customer is allowed to buy a maximum of 3 kilos to avoid reselling and hoarding. However, a supermarket group says that this initiative could affect commercial sugar sales.
They probably won't be selling washed and brown sugar, no? Kasi 70 a kilo for white will be cheaper than brown or washed sugar.
The group also questioned whether the initiative would be sustainable in the long run. The government has been looking for ways to stabilize sugar prices as the country awaits additional supply from imports and local production. For News 5, Gio Robles, we are One News.
Though sugar prices remain elevated, a group of sugar producers believe have a white and sweet Christmas as supply begins to stabilize. Speaking to the big story, United Sugar Producers Federation President Manulet Lamata says around 200,000 metric tons of sugar have already been milled and processed since the harvest season began early this month. Lamata says this supply is now in the process of being shipped to Manila as refined sugar. He notes the government's selling of the 70 peso per kilo BBM sugar is merely a stopgap measure to give consumers access to affordable sugar as retail prices remain above 100 pesos. But Lamata assures consumers that prices will soon stabilize ahead of the holidays.
We're feeling it already. Yung unang umpisa ng harvesting namin, ma'am, they were buying at us for 75 pesos mill gate price on a row. Right now, ma'am, it's down to 70. And this week, we believe it's going to go down to 65 now. So again, the nature of supply and demand is kicking in. So konting tiyaga na lang. I believe we're going to have a white and sweet Christmas, not that expensive po.
The country's major airlines will slash fuel surcharge effective November. This after the Civil Aeronautics Board announced it is downgrading its fuel surcharge from level 9 to level 8. Under the matrix, the maximum surcharge for fuels in domestic flights stands at 787 pesos under level 8. That's lower than the current 839 peso maximum. For international flights, the maximum surcharge will be at about 6,200 pesos, cheaper than the current amount of over 7,000 pesos. Local airlines say they are pleased to comply with lower surcharges and make airfares more affordable as the holiday season nears. And those are the biggest stories on the economic and corporate front today. I'm Jess Delos Santos. We are One News, all sides, all the time. Don't go away. We'll give you the latest on the local bourse when Businessworld Live returns. Stay with us. And you're still watching Businessworld Live here on One News. Now, the index was on a tear as it extended gains for a seventh day on Wednesday. But will the streak continue or will it follow the rest of Asia as the region starts the day with a sea of red following declines in Wall Street. And as you can see in this chart right here, we seem to be following that trend, mirroring those losses across the region. So far, you have the index down by close to 0.6%, make it 0.5% to 6,116. But still, nonetheless, like what we mentioned earlier, we've seen so far a 7-day streak here for the index. In fact, over a 3-day period, we still managed to eke out a gain of 2.4%. And as this, of course, as investors were in bargain hunting mode over the past week ahead of earnings reports. So far, there have been, of course, solid numbers from U.S. corporations, boosting sentiments that things might actually be better than what was originally feared, at least according to Luis Limlingan of Regina Capital. And speaking of earnings, you have the first one coming in this morning. The country's second largest bank, we're talking about BPI, of course, releasing their third quarter numbers. You have net income at 10.1 billion pesos. So that's going to be a big jump, of course, compared to the 5 billion peso level it posted back in the third quarter of last year. Also, you have revenue coming in at 29.8 billion pesos. That's a jump of 26.8%. That's on the back of double-digit growth from net interest income and non-interest income, as well as a growth in their customer base to over 9 million. Looking at their figures for the first 9 months of the year, net income is now at 30.5 billion pesos. Revenue also soaring by double digits, 22% to 87.5 billion pesos, and net interest income growing by 20.5% at 61.6 billion pesos. BPI shares, of course, enjoying quite a bump up because of those numbers here. The stock up by close to 1.1%, now at 93 pesos a piece. We might as well take a look at the rest of the financial space on the back of those quite rosy numbers for BPI, as well as, of course, as the BSP statement that it's ready to use other tools to curb the peso's volatility. However, you can see only a number of lenders starting the day in the green here. BPI, again, top performer so far, followed by PNB up by 0.6%, as well as East West Bank in the green, Union Bank and BDO, however, in the red here, with Union Bank down by 1.3%. And lastly, let's have a quick check of the peso, following again the central bank statements that they are ready to use other tools to curb the peso's volatility. As you can see here, some signs of weakness here for the peso as we start the day here. We're at 58.991 to the greenback. And that's it for today, October 20, 2022. Join us again tomorrow at exactly 9:30 a.m. You can also catch us on Signal Play. Register for a free account now at www.signalplay.com and stream One News live anytime, anywhere. I'm Jess De Los Santos. Stay safe, Philippines. We are One News, all sides, all the time.